All right, what Dave Ramsey does not like about ETF
Hi,
funds. I'm a
Deborah.
big
Welcome to
fan.
the Ramsey
Let's
Show.
see.
Hi, thanks so much. I've been listening to you guys for years and appreciate all you do.
Well, thank you.
I have, you're very welcome. I have a question for you. I've been listening for a long time, and yesterday I went in to adjust my own investments because we've been focused on other things. I wanted to get everything set up in the four different types of mutual funds you mentioned. And the guy who is not a Ramsey certified financial pro, but he mentioned a term that I'd never heard before. When I brought up mutual funds, he asked me if I'd considered ETFs, and I had
This is why it's so important to pick like someone of high moral character when you're investing for advice, not just that they're knowledgeable, because there's such an asymmetric level of their understanding of the market versus yours, right? Not knowing what an ETF is like not knowing your ABCs, right? Any person who's just a fan of finance in general will know what they are.
have no idea, or I hadn't heard what that was. He explained it to me, and it sounds very similar to a mutual fund. So I was just wondering if you could clarify what the difference is and why a mutual fund is better than an ETF.
ETFs are exchange traded funds, right? There's a set of rules to go into the fund or an index in this case, right? And then mutual funds are just like actively managed, right? Higher fees. You got a guy deciding what's going in there. He can change it on a whim, kind of.
I don't know that a mutual fund is better than an ETF. ETF just means
It's not.
exchange traded fund. And for purposes you would use it for, they're very, very similar. They're almost identical. It's a group of, a group of stocks. And if you're buying an exchange, typically what people will do for an ETF is something like an index fund, like an S&P 500. And so
Right.
it'd just be
Okay.
a group of stocks in there. Now, sometimes uh, brokers will try to get you to buy and sell in your portfolio a lot, and they like an exchange traded fund for that better. And so if you're setting it up to do,
So an important difference right here is that when you sell a mutual fund, it closes at the end of the day, right? ETFs trade liquid throughout the day. So if you're buying and selling, it's a lot easier to do that with an ETF.
like you'd set up a brokerage account to buy and sell stocks in, I would not use it for that. But if you're using it like a mutual fund just to buy and hold, you're going to find it's almost identical, that you're not going to notice any difference in the practical use of it. So sometimes I hear things like, well, Dave Ramsey's against ETFs. I'm not against ETFs. I don't mind. What I want you to have is a diversified portfolio, mutual funds, ETF
Makes
is
sense.
either one of those will give it to you. What I don't want you to do with an ETF is start buying and selling all the time. And I don't want you to use any vehicle of investing that prompts you to constantly be jumping in and out, jumping in and out, jumping in and out.
Yeah, he's correct, right? You shouldn't be jumping in and out. That just makes no sense, right? You're paying for each transaction. It just doesn't, you lack conviction. And how wealth is made is by buying and holding. But on the flip side of that, right? An index fund just tracking the S&P 500, an ETF tracking the S&P 500 outperforms 80% of all other mutual funds, all other everything. So it just doesn't really make sense at this point. There's not a lot of data to show that it makes sense to buy other things yet, unless you just have some sort of like yeah, like edge in some sort of market, right? Something that the market is not realizing.
Because every time the news is good, by the time the news is good on the stock market, you're late. You
Yeah.
should have already been in. By the time the news is bad, it's already too late for you to get out.
Right. There's an asymmetric difference in access to information and speed at which you have access to, right? The average investors like us, we are the last to know. So we'll get hosed in a lot of these, when a bank is about to collapse. What was it? I forget the one in California that blew up, right? All of the big boys got their money out early, right? The average person was the last to know.
And so people that try to jump in and out based on the news, and you're not saying that, Deborah, I'm just saying, but in general, if you're trying to use an ETF to time the market, we call it, then that use is not something that
She's not.
that we would tell people to do ever. Because I don't time the market. I just buy and hold. I never sell it. I just buy and keep it. And the stock market went down. Yeah, I know. Stock market went up. Yeah, I know. And if I just sit there, then I'm fine. And so, But
Because why buy and hold at its core level works is you're just asking yourself, do I think the economy will be better and larger in 10, 15, or 20 years than it is today? And it's like hard to argue no, right? Sure, there's some like headwinds against certain things and certain things aren't going well today, but in 15 years, like there will be more stuff, more things, more economic activity in 10, 15, 20 years than there is today. That's the fundamental thesis here.
for your purposes, Deborah, I think he's fine as long as you're going to stick with it, and as long as he's not, your planner is not recommending the ETF for purposes of timing the market or buying and selling or constantly trading on your funds. I don't be trading on my funds all the time. I buy them and hold them. The only time I sell a fund is if it's just completely underperforming its category over a long period of time. And I don't remember the last time I sold one. It's been a long, long time because I play long ball all the time. Play long ball. I'm always thinking, what's this going to be 10 years from now? What's it going to be 20 years from now? Not 10 days from now, not 10 months from now. The emotions don't drive it. And again,
Right. If you can control your instincts and have a long time projection, you will become wealthy. That is the real kicker, right? That is the thing that separates the millionaires from the people that have no money. Is they're able to, delayed gratification. That's the word I'm looking for. You need delayed gratification. It's so hard today, and it's even more rare today now than ever before because everything is instantaneous around us.
Deborah, you're not being accused of any of that, but I'm trying to couch my ETF answer here so I don't get misunderstood again. Because I'm not
Sure.
anti-ETF, I'm anti-timing, and I'm anti-constantly trading.
Because it's effectively gambling. If you try to play the market, you can really
You're
get
no
burned
longer
quickly.
investing, you're speculating.
That's correct. Yep.
And you are, from a
There's a fine line. We're all kind of speculators in a way. We're just, if investing is a speculation on a larger time horizon, right? At its core level, we're all speculating because no one's going to invest in something thinking it's not going to go up, right? Like we're investing because we think it'll be worth more in the future.
statistical standpoint, not a spiritual standpoint, you are gambling.
Right.
And
Yeah.
so, and sometimes I hear people say in the Christian world that I'm in, they'll say stuff like, "Well, all stock market is gambling, and you shouldn't be doing that." Well, you don't understand what gambling is.
Yeah.
Gambling is not based on gambling is based on it's a game of chance.
Right.
Correct.
Meaning you don't have any control or any insight
That's right.
over the output.
That's right.
Investing is you buy a piece of real estate. Why? Because real estate's always gone up, and real estate in that neighborhood's a great neighborhood. It's got nice trees, and it's going to be good, and whatever, and
Yeah, what he's kind of getting at here is there is a difference between gambling and investing, right? Gambling is pure chance, right? Investing involves an element of chance, but there's other factors that go into the input, right? Work ethic, is the company doing well, the other trends in the market, right? There's things that you can see, right? Long-term trajectory of growth. And I think the fundamental core thesis that Dave has is, do we think the United States will be wealthier in 10, 20, and 50 years than it is today? And if you can answer yes, then invest, right? If you answer no, then buy gold or stack cash.
or if you're in Arizona, nice cactuses or whatever it is, right? And so, but we have actual outputs that we're measuring, and we can look at the probabilities, and it's not just a deck of cards. It's not a slot machine. There's a
Yeah, so we'll end it here. He's actually not a hater on ETFs. I thought he was going to come out hard against them, but he kind of sees the light on this too, right? ETFs, the main difference between the mutual fund versus the ETF, ETFs are cheaper, they're more liquid to trade, they don't have as higher fees, they're not actively managed, right? You're just picking a trend. Most people are best off with just buying the S&P 500, calling it a day and going to sleep, right? If we know that 80% of mutual funds fall short of the S&P 500, then it's like you're statistically way more likely to make money by just buying this simple 500 basket of goods and calling it a day. No more complicated than that. We don't need to overthink it here.